Hey everybody, so today we are going to be talking about interest rates and how that has been impacting the state of multifamily over the last probably year or so. We get into a couple of examples, what we're seeing in the markets. And then we make a jump over into insurance and the importance of having quality insurance that is going to cover your assets so that you don't run into any type of issues with your thesis or any of your investments or anything like that. So you want to make sure that you have that coverage.
Hello and welcome. This is your host, JP Albano. I'm joined here by my partner and business wife, Mr. Matt Shields. Matt, say hello.
JP, how you doing?
Doing great. We just got off of our normal weekly Wednesday call. It's been a while since we've done these. We both have our own podcast shows. So it kind of occurred to us, let's just capture some good, and we'll keep things going. So I think kind of the new format and kind of relaunching the show here is to do the following, right? I think before we were kind of just talking about various topics that we thought were relevant to our investors. I think, when we started our company, we divided and conquered into two different areas, right? I focused on the business development piece, finding roles, investor relations, things like that. And then Matt took on the responsibility of all the operational aspects and elements. And so, what we thought would be great for our listeners here is to kind of each week we'll record a little episode and talk about, our unique area of expertise here. So start things off. I'm happy to kind of go into what I'm seeing or what we're seeing on the acquisition side. What's the state of the state with the market right now with interest rates? This recording is done here in August.
It's
I know
August
Matt,
30.
it is, which means we're 8 months into the year. We've passed the point of halfway through. We're well past that. But I know, Matt, you had started kind of getting more involved in some of the acquisition things as to help me kind of offload some things on my plate so I can focus on the marketing thing and kind of building up our investor base. But I will share with you, over the last 8 months of this year, it's been a very, very different time. The impact that interest rates have had on multifamily is sort of interesting in a couple of ways. We'll talk about the acquisition side. I feel like if I had a pot of gold right now, right, I followed the rainbow to the pot of gold, I would take that pot of gold, go on a shopping spree. I would just be buying balls to the wall. The reason that is because I feel like now more than ever, there's such an opportunity to buy distressed assets, buy distressed deals, and also take advantage of negotiating leverage points to negotiate lower prices. Right before, it was like, you're competing with everyone and their mom. It was totally a seller's market. There's a ton of competition, and the seller can basically say, name their price. Now we can point to, look, Mr. Seller, I know you want to sell it for XYZ, but like my interest rate for this loan is going to be 7, 8, 9, 10, 11, 12%.
Mm-hmm.
I can't support the mortgage payments at that level. So the only thing that has to give is your purchase price. And the great thing about that, Matt, right? This is like, purchase is permanent. So getting in at that low value, the low price is really, really key. That and the fact that I think the buyer pool has kind of shrunk a bit, right?
Mm-hmm.
So there's less competition, less people willing to kind of entertain offers, helps us, right? That just kind of sets up this perfect storm of being able to kind of have these opportunity buys.
Mm-hmm.
How does that, what are your thoughts on that, Matt?
Yeah, no, I mean, obviously you make your money at the purchase, right?
Sure.
And it's all about being able to get those deals. I've stepped more into this in the last, call it, month or so, but certainly have had some conversations with people that they are, looking, or they're in positions where they have to sell rather than, exploring selling, right? So, obviously when people are put in those kinds of positions, there's going to be motivation to get out of the asset. And it's interesting. It's not only the interest rates. Obviously, the interest rates have a big impact on this, but other things like insurance rates too are having a huge impact on the value of the property as well, right? Insurance rates in some cases have doubled in the last couple of years. which no one was expecting that to happen. I was talking. I don't remember who I was talking to, but they said that if we can go 18 months without having any major storms or anything like that, that should tamp down what people are or what the insurance companies are asking for, the premiums, which I didn't realize. I mean, I guess it makes sense, but I didn't really realize that the weather outcomes actually play a role in those prices. So
Yeah.
hopefully, fingers crossed, we go through this storm season and we don't have all that terribly many issues with that.
So you brought up a good point about insurance. So I like to break that down for a second. So here's the impact. When we create a pro forma, it's a forward view of the property financials over a period of time. Buy a property, we analyze a property, we say the current profits it makes, the NOI is $1 million a year. Great. Well, we know if we can do X, Y, Z renovations, we can increase the rent $100 times 200 units is $200,000, blah, 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 blah. We can get that NOI, that profit to maybe $1.5 million in the next 2 years. Well, you have to also account for how your expenses increase over time, right? Things like your payroll, things like your property taxes, utility bills, and a lot of those things have kind of historical inflationary variables that we use. So maybe 3% water and sewer bills and 2% for, I don't know, general administrative things like fees and postage and all that kind of crap. Well, when it comes time to insurance, you know insurance is going to increase, but you typically in back there, it might have been like 3, 4, 5% sort of annual increase. But when you get hit with your renewal and it's 25, 50, 100% increase, that is so incredibly damaging, and it is completely outside of the control of an operator, because you cannot buy a deal and underwrite for expecting the insurance to double in price, right, in a year's time. Mm-hmm. And it's sort of this really, really interesting but sucky circle of like black hole sucking events, because the Fed, that's responsible for creating inflation in the first place, ironically has a mandate to lower inflation. But you've also got the insurance industry, which is trying to be profitable and have enough money to be able to cover losses, realizes, oh my God, there's a whole bunch of losses that we had. We need to kind of pump up the kitty. But in order to do that, we've got to make everyone's premium more expensive. Well, when you're operating an apartment, one of the beautiful parts about an apartment investment is that it is inflation resistant and recession resistant, right? But the inflation part is meaning we've got an opportunity virtually every month when a renewal happens to go into a renter's policy and say, look, our expenses have gone up. Your rent was going to go up 2%. Looks like it's going to have to go up 5% or 10%, right? Whatever, to make the ends meet for us. And unfortunately, when you get a renewal for the insurance that goes up double, that's a lot to take on. Mm-hmm. And I know, Abby, you maybe can talk about this with one of our properties in Ohio. Like, that money has to go somewhere. The money has to come from somewhere. It just doesn't come from the sky.
Yeah.
And so it forces us to actually go maybe a little bit higher on those renewals, because crap, man, you've got to pay for that somehow, and you cannot not have insurance.
Yeah.
That's just,
yeah. And I feel like a lot of people may not necessarily understand the different levels of insurance too. So there's replacement cost, and then there's what do they call it? I believe it's like type replacement or something like that. And a great analogy, that the way that this was explained to me with the like, and that's not the right term, but it's like replacement or something like that. With that one, imagine you had this beautiful ornate mantle, right? This mantle, mahogany, all carved, beautiful, right? You have a fire and the mantle gets completely destroyed, right? Cool. So with the replacement, or with the like replacement insurance, they could actually replace that beautiful ornate mantle with a 2x4. It's still functional. You can put your cup of coffee, some books on there, but it certainly wasn't what it was before. Whereas with replacement cost value, or with replacement insurance, it would put back that mantle to the way that it was before. So you want to make sure that you have adequate coverage so that you're able to actually repair the property back to the way that it was,
What?
at least the way that it was.
Right.
Should you have any events happen. But a lot of people will say, "Oh, I'm just going to go with the least cost,
Hey, hey, man.
yeah, the whatever the least premium is that I have to pay. That's what I'm going to go after." And you're going to run into the problem of having a 2x4 replace your beautiful mantle. So you want to make sure that you're
What's not crazy, but I think it's maybe for most people, they don't really, thankfully, have to use insurance very often. But when you're operating an apartment complex, you have many lives consolidated into a parcel of land or parcels of land. So, if you've got a 2 or 3 story garden style apartment complex, 3 people living on top of each other, the chances of there being some sort of kind of crazy life event increases, right? Car fire, house fire, stove fire, whatever. That, unfortunately, shit happens. And so, like, having good insurance, I feel like, is one of those things where it's worth it.
It
right?
is, yeah.
And especially like, we're in value add apartments. The whole point of adding value is usually adding some sort of cosmetic improvement to make it a nicer place. And if you're stuck with putting 2x4s on your mantle, well, are you going to be able to capture that same rent premium that you were before with your mahogany mantle, using your analogy?
Right.
Maybe not. And so, you're putting the deal at risk, your investors at risk, your thesis at risk. And that's not a place that you want to be.
Yeah. Yeah. And there's all kinds of things too. This isn't just on the coast either, right? Last year here in Cleveland, on Christmas Eve, we had a cold front come through that was like literally like minus 60 was the wind chills. I think it was like minus 20 was the temperature, which doesn't happen. I know a lot of people think that, Ohio can be the frozen tundra, but that doesn't happen here. We had a few and we had a few pipes break, but the problem was that this was the entire region, like
was breaking.
Whatever 500, 600, 700 square miles of everyone, was all having the exact same issues. So getting a plumber, number one, it's Christmas Eve, and then getting a plumber because everybody was busy handling thousands of other calls. Was just it was rough, right? So a lot of people think like storms, and they're looking at the coastal areas with the hurricanes. That's part of it. You've got your wildfires. That's part of it, and then you've got these freak cold things. Part of it as well. And of course, then obviously there's always tornadoes and all of that other stuff too. So there's any number of things that can impact what you have to make insurance claims for.
Crazy. Well, with that, Matt, I think we'll wrap up this episode. Thanks so much for listening. And you can do us a big favor. If you like this episode, go ahead and hit subscribe so that you can stay tuned for more episodes and more content that we create that will definitely tickle your real estate fancy.
Beautiful.
With that, thank you so much. Anything you want to add?
No. Thanks for having me over here.
Sounds good. I'll see you later, Matt.
See ya.